Hi, I'm Peter Rose, founder of Longwood Currency Trading. Thoughts on the retail forex trading market. Now, just a caution on that. I want to repeat that. Thoughts on the retail forex trading market. I didn't say trading the forex market. I said the forex trading market. There's a big difference, and so let's get into it. You notice I had to get my coffee first. So I'm going to set this up and we're going to start this, okay? All right. Phew. The retail forex trading market is the market itself that we're trading against. It's that market that our rules have to be constructed in order to win some money. We're in a market that is overpowered at $7.5 trillion a day, at least 95%, if not a little bit more, of institutional traders. We're 5% or less of that market. Back a year ago, when the market was at 6.7 trillion, or 2 years ago, whenever that was, the retail traders were 5%. That was the statistic that I came out with. We're $1 trillion more in that market, so I'm not sure that the retail traders are keeping up with that. So less than 5%. So we're in a swimming pool trying to swim. We're good swimmers, but all around us are Olympic swimmers. So we're not going to beat them, as I said in my last video about can you beat the market? No, you can't beat the forex market. So we have to understand what that market is and where we come into play in order to take our profits. We're not the dog in this thing. We're the tail. And if we're not careful, if our rules aren't correct, if we don't understand the real problem that we need to write the rules to solve, then the dog's just going to turn around and bite us. He ain't going to bother to wag his tail to shake us off. I caution you that this is not a discussion of fundamental analysis. That's totally different than looking at the characteristics of the market you're going to play. If you're going to play backgammon versus chess, you've got to look at the game differently. We're not talking about the tactics or the strategy or anything about the difference between moving a knight to king 4 as opposed to a backgammon checker that moves somewhere. That has to be clear if we're going to understand the forces that act on that market to cause it to do what they do, which we simply call order flow. Behind order flow is an institutional trader, and behind the institutional trader is a client of a country that wants to sell his currency to buy the currency of another country so that he can buy that country's products. That's the market that we're trading in. So you can't do fundamental analysis against that, because it's hard to do fundamental analysis against GE stock, let alone a city's policy, let alone a whole country's policy, let alone two disparate countries with different interest rate policies and thoughts on how their economy should be operated. That's the backdrop of my thoughts on the retail forex trading market. You've heard me say many times that price action doesn't change, and it doesn't. We're trading the same way. Our rules have to be flexible, however, when the market conditions themselves change. The biggest example of that is when you go into a trending market of price action as opposed to range bound or chop. You don't change the way that you trade. Your rules should be constructed so that you're not caught at the top of a swing, still thinking it's going to go up, and it turns around and it goes down. Or you think the downturn was a swing point, and so you're flipped and it goes in the opposite direction against you. Your rules have to be agnostic to the market. But if you don't know what conditions are driving the market and what the effect on the market is because of those conditions, then you're going to have a hard time writing your rules. That's the purpose of this video. So if you're looking for entertainment or the magic pill about how to trade Bollinger Bands or some fucking thing like that, then go watch an entertainment video. Because I'm going to spend the next 20 minutes talking about what's changing in the current market today, which is the end of September of 2025. And I'm going to point out that though these changes may be specific to this particular time frame, changes in the market are going on all the time. These just happen to be different. And I'll explain to you what those changes are, what they're causing, and why. Well, I don't have to explain to you why they're different than some normal change like enhanced NFP change or I don't know, a big bug infestation of lumber, and that causes the currency market to go out of whack because the guy's got to end up paying a couple of $100 more, maybe, or a couple of $1,000 more for his load of wood to build a porch than he would have before. And so the client who's building a condo project and it's 18 months out, he's going to be really concerned in a change like that. But those are individual changes, and they don't hit the currency market itself as dramatically as they would a commodity price action or a stock. The president of a company, turns out he absconded with $200 million, and he's in Aruba living the high life, and meanwhile the company is going broke. That company's stock is going to go just really quick. Or there's a drought in Kansas City. Wheat is decimated, and so the price of wheat goes skyrocketing in 15 seconds. That doesn't happen in the currency market because you're not dealing with Kansas City wheat, one particular thing. You're not dealing with Bob and Jane's lawnmower company. You're dealing with a whole economy of two different countries. It's like two ocean liners going along, and there's an iceberg up ahead, and the captain says, go port, turn port, get out of the way of that iceberg. Well, it's going to take a long time for that ocean liner to turn and get off course. So you have things that move more slowly. And the more the dramatic of the change, that speeds up a little bit, and you get an immediate burst. Like the other day, we had our interest rate decision, September interest rate decision for 2025, the first one after 2 years of rising interest rates. Over 7% is a 0.25% drop. And even though that was probably 80%, 90% expected, we were expecting that we would have to have a drop in interest rates. It could have been 0.5%, or because of the PPI and the CPI data that just came out as well, the Fed could have said, well, we're going to wait until October to change it could have gone either way. But the most probabilistic event was a 0.25 point difference. That's what came out. And yet the pound dollar, the dollar just plummeted and the pound went screaming up. Why did that happen? Why did that happen? And is it important that it did happen? And it isn't, because in the 5 minutes that it took price to move, it was about 60 pip shoot up. That ended, and price started to chatter, and then it came down. I wasn't involved in any of that. I had traded a couple hours before that, knowing that I didn't want to get involved in interest rate decision thing. So I had done my trading earlier in the morning. The interest rate decision didn't come out till 2 p.m. Eastern Time, U.S. And so I made about 1% against my bank, and just closed it up and stayed through that. But within an hour or so, 3 or 4 15-minute candles, price had come down to exactly where it started from when the interest rate decision was released. So what's going on? What has caused that? And again, we have to look at the conditions of the market to see that, and not specifically, oh, this is the event that caused that. Because the currency market doesn't behave like that. Oh, the retail traders do, and there were a lot of them that got caught, and they were on the wrong side of it, and the institutional traders knew that a lot of them would be on the wrong side. They also knew that a lot of them would be on the right side. So my guess is, though the institutional traders weren't trading the accounts for their clients, they were in there saying, we're going to run this thing up, get everybody come on board and buy, and everybody who's long is going to be convinced that that's the great way to go. That's 60 pips, and very quickly everybody panicked and got on. That's why you had that spike. All of a sudden it stopped. People held their prices, and then it dropped like 30 pips right away, and it took everybody out. So the institutions weren't driving that. They were simply taking advantage of the stupidity of the retail trader, who's 90% wrong. There's 90% probability the retail market as a whole is wrong. Was that the institutional traders stop hunting and Forex is a scam because of that? No, it's business. They saw some product that was on sale, they went in and bought it. And then when everybody was in there buying it, they sold out. It's business. If you don't understand business, then you're going to have a hard time understanding the points that I'm going to be bringing out here in the rest of this video. In any event, what are the conditions that we're facing right now as we move into the fourth quarter of 2025? My position is that this is a rare change that is about to interact with all the financial markets, and in particular, it will affect the currency markets on a long-term basis. It's similar to the Brexit event. There's this horrendous 800 pip spike in the dollar going way up as the pound just tumbled. And that stayed there because there were firm market conditions and economic conditions that said, no, this is the new real. And I believe that as we move into 2026, over the last 5 years, maybe 8 years, we have begun to change the next new real. Let's go back to the 2008 financial crisis. We are still coming out of that, and the consequences of the 2000 financial crisis were exacerbated by the 2020 pandemic. In the wave of the financial crisis, the reboot from that, and then the recrash of that because of the 2020 pandemic, we had an enormous change in the way that folks looked at working at remote work as opposed to going into the office. Not only was that a change in the view of the employee, that has to change the view of HR at the different companies as to how they're paying their employees, how they're qualifying their employees, how their expectation of their employees is. It's going to get tougher to get hired if you want to be a remote worker because you have to have a proven track record of having the discipline to sit at your computer and do your freaking work. And there aren't a lot of people that are able to do that. But now, because the market is changing and people are going to remote work, there's a lot of people, because of the changes in the market, meaning the advent of AI, for example, a lot of the jobs that you could skate by and do remote work and be brainless are going to be not there anymore because those jobs won't exist. As I was saying in one of my last videos, excuse me, owner of a large corporation that was a financial corporation. They're in the business of buying businesses. and they had employee level of financial advisor. And that financial advisor was a highly educated person that would go out, analyze these businesses, do profit and loss statements, look at balance sheets, look at the comparison between that particular individual business and the industry group the business was in, and all that kind of very detailed, complex financial analysis. That company, that position was $175,000 a year. And each company had one of those people in them, and they had multiple companies. All of those people making $175,000 a year were removed and replaced by a $200 monthly subscription to an AI system. So those folks that weathered the 2008 crisis, then moved into the pandemic and demanded remote work and were dealing with the technologies that we had at that particular time and were undisciplined and would just skate through and work. And the employers had to put up with that because they had to stay in business, so they needed these people. However, as we're coming out of all the financial crisis and coming out of the pandemic, the way that we're looking at the change in work is at the remote work is changing, and the advent of AI is going to make a lot of those people that were working remotely successfully redundant, and they will be replaced unless they are improving their skills. The whole interest rate raise just now, with the Fed coming out and saying, well, we're going to knock down 25 basis points. That's the beginning of a change. The fact that the pound dollar went 60 pips in one direction is absolutely of no concern. The dollar will continue to go down. The pound may go down. We may get back to parity on some of these currencies because everybody is going to be readjusting their methodology of doing business and the people that are going to be needed in order to do that business. In addition, here we are at the end of September 2025, we're moving into the fourth quarter. The fourth quarter is characteristically a very dynamic, volatile, and hectic market for all of the financial markets because the companies are all trying to stabilize their businesses and put everything together so that their numbers are going to come out well, either on a calendar financial basis or on a fiscal basis when their numbers come out in June. But everything is based on we get a mulligan on January 1st. So we got to set the table really well so that we can do a real good restart January 1st. All of our hiring stops in October unless we have budgets that need to be used up in order to get the hiring for next year. But guess what? A lot of those people that get hired in October, they'll get whacked in January and February because they aren't good enough. And then the rehiring will go on from there. Once the company knows what everybody else is doing, they can make financial plans for the next year. Characteristically, if you look back over the last 50 years or 40 years of real estate, of the stock market, I've been studying the general financial market since the mid-1970s. I went through the oil crisis and embargo of 1973, so I was studying the financial markets back then, and then studied commodities after that. I didn't get into the currency market until I was in my 60s in 2007. So I can look back and I can see I've been through 4 financial meltdowns in that period. I've lost $1 million twice in my life. I did spend 40 years in real estate investment, and I lost $1 million net worth twice because of the real estate crisis during those periods. I was able to make that $1 million back each time, as I've said in many videos, but it took me 10 years to do that each time. And so as I moved into the 2020s, I began to peel off that real estate because it was accelerating. And I said, I was 75, 74 years old. A blow will come. the blow off could have come 2 years ago. I went flat and went to cash for all my stocks and sold my real estate and was flat there and went to cash because I just didn't know what was going to happen. Well, I could have made a lot more money if I would have hung on, but that's okay, because when you get caught on the wrong side of real estate, you can't get out, and you watch your portfolio totally disintegrate in 4 months. The last real estate crisis that I went through, I think it was a 2008 one. The condo I was living in at that time that I had bought was about $250,000, and that evaporated to 150. It could have been 130,000. I mean, I had a market analysis done because I was thinking about moving, but it took us a couple of years to figure out where we wanted to go. So I just wanted, what would I get for it if I had to move now? So it was about 150,000, $100,000 less, probably a little bit more than 100,000, more than 30% drop in real estate. And it continued to drop. I was in a nice project, so it didn't drop as much as it dropped in some of the other ones. Some of the other ones were decimated. So I was not willing to go through another disaster like that. So I sold out. Did I go early? Yes, I go early. I could have made a lot more money, but I own my house now with no mortgage. I was able to buy that house back then without having to sell my first house because of my real estate investment. I planned these things. I'm aware of what the markets are. I have that experience. It was time to sit down in a chair, because if I waited, there might not be a chair to sit down in when the music stops. So yes, my cash has lost 6 or 7% a year as it sat in limbo land, but I made up for that in my currency trading, because that's not affected by any of this stuff other than, or the trading of it isn't. Price action will change based on the markets. There'll be pin bars and panics and Brexits and all that other kind of shit, but you trade that and you go both sides of it. So to me, it's a safe market. However, as we move into this fourth quarter and we look back over the last 40 or 50 years, as I was saying, we notice that there's a very strong probability that October there'll be a stock market crash or a market crash of some kind. If you go back and look at the stock market crashes, most of them had their initiation in October, and if not, certainly the death toll in October. And it is because the businesses are rearranging themselves and putting themselves onto better stead, so that when they start the new year, that they can get a new fresh start. But sometimes all of that rearrangement causes panic, and it's kind of a self-fulfilling thing. So this is the stuff that the currency market has seen over the last 8 years, let's say. 2008 financial crisis, 2020 pandemic, the change at the way we're looking at remote work, the effect that had on the real estate market, as well as the interest rate acceleration during that period of time, which has adversely affected commercial real estate in a big way. Even in New York, commercial real estate right now is down. That's the leading indicator that real estate market is having a hard time. And so the interest rate problems that were caused going up, now we see interest rate changing. There's still all the crisis and stuff going on because of that, and the lowering of the interest rates will cause problems in itself. There'll be a new set of problems that are created by the reduction in interest rates. And they won't come fast enough to save the real estate market. That's got to flush out. And we're in the fourth quarter. Whew, that's a lot. So the financial world is filled with really, really smart people. Berkshire Hathaway has got something like $135 billion in cash. Why? A lot of the big funds are switching their focus and what they're carrying. There's a sense that things are not going to go well, that things are going to have to go very, very badly to reset the markets so that in January we can start the new. I would suggest that if you are a currency trader now, you have the experience of looking at the market and trading it. But if you're not having the success that you think that you should be having, you're going to have a very difficult time if you don't understand these changes in the market and how they're going to change the currency market. Not the way that we trade it, but they're going to change the market, which means your rules need to be consistent with what I think will be seen happen in the currency market. So if you have any questions about this, I have a fast track course. I'm not trying to sell you fast track course because I'm a sole proprietor and I can't deal with 100 people a month. It's not an online course where you dial in at your leisure and join stupid Discord groups so that you can be in a group with a lot of other people that don't know what they're doing. I work individually with you. That's why the course is expensive, because I'm working with you. You can ask me questions in real time during the 6-week period of the fast track course. And we try to get through the course in 4 weeks so that we've got that extra 2 weeks to get the changes. And I've talked about this before. I don't have to go into it anymore in this video because this isn't about taking a course. It's about sending me an email to see what I have to say about what you're doing with your trading. If I can help you and alert you to something right away just by us talking, and we may do that through email. It may be as simple to do it through email. But I'm certainly willing to get on to a video conference with you and talk with you about what you're doing in your trading. If I can help you, that's great. You'll remember me, and you will maybe. But you don't have to take a course. And I'm fine with that. But if I can help you that way, that's great. If you'd like to talk to me about the advantages of taking a course so that you're not making the mistakes that most guys have to make and lose tens and tens and tens of thousands of dollars, if not hundreds of thousands of dollars, like I did, in order to learn what not to do. If you have that kind of money and you're willing to do that, then maybe I can help you get over your early stuff. But there'll be other things that'll catch you. Maybe you'll be able to get through them. But I'd like the opportunity to show you where my knowledge base is and whether we can be compatible as teacher-student. And then if you want to talk about what's involved in the course, the specifics of it, and how much it costs and how long it lasts and what you're going to be doing, I'd be happy to discuss that with you. But I'm not going to push you to buy it. I'm not going to go, so Bob, give me your credit card number. That's not what I do. Again, I only want to work with a few people, but I'd love to talk with you because I like to talk about currency trading. So hit me up with an email. Tell me a little bit about yourself and what your trading is like. And if you have a specific question, ask me. Maybe I can respond to it in an email. If you'd like to have a video conference with me, just to chat with me, I'd be happy to do that. If you go to my website, longwoodcurrencytrading.com, to the currency trading page, there are 7 reasons I list why I stand behind my decision to move out of real estate and go into the currency market. Why I think the currency market is the most viable market that you can participate in. And if you'd like to chat about that when we exchange emails or have a video conference, I'd be happy to go over the details of that. A lot of people will get involved in those conferences. Why aren't you in real estate? I was thinking about doing real estate. Everybody's talking about real estate. Why shouldn't I be doing real estate? What should I look out for if I do want to do real estate? Sometimes the conversations turn to real estate instead of currency trading. And that's fine. I enjoy those kinds of conversations as long as I have my coffee. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.